How does the neutral rate affect interest rate hikes? Imagine trying to find the perfect balance on a seesaw. That's what central banks do when they set interest rates, aiming for stability without tipping too far in either direction. The neutral rate of interest is like that ideal balance point. It's the real short-term interest rate where the economy is at full employment and inflation stays steady. Think of it as the middle ground where monetary policy is neither pushing the economy to grow faster nor slowing it down. Since the neutral rate can't be directly seen or measured, policymakers have to estimate it based on economic data. They look at things like productivity, demographics, and global economic trends to get a good idea of where it might be. When they decide whether to raise or lower interest rates, they compare the current policy rate to this neutral level. If the policy rate is below the neutral rate, it means the central bank is making borrowing cheaper than what's needed for a balanced economy. This encourages spending and investment, which can lead to higher inflation. On the other hand, if the policy rate is above the neutral rate, borrowing becomes more expensive. This slows down spending and investment, helping to reduce inflation. Interest rate hikes are usually aimed at pushing the policy rate above the neutral rate. When they do this, borrowing costs go up, making people and businesses less likely to take out loans. This reduces overall spending and cools the economy. The goal is to bring inflation down without causing a recession or increasing unemployment too much. Because the neutral rate changes over time with shifts in productivity, population, and global conditions, central banks must keep estimating it. If they raise interest rates too far above the neutral rate, they risk slowing the economy too much and causing unemployment to rise. If they don't raise rates enough, inflation might stay high. In the end, the neutral rate acts as a guide for central banks. It helps them decide how much to raise interest rates to control inflation while keeping the economy healthy. When they understand where this rate is, they can better time their interest rate hikes and avoid unnecessary economic pain. So, the neutral rate is like the compass that helps steer monetary policy in the right direction.